Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for November 2015. We're going to walk through the major market events of the month. November saw the S&P 500 rise for the second straight month, albeit the market's advance paled in comparison to the 8% surge in October. That being said, it was encouraging to see the market rally the latter half of the month after pulling back early in November. One of the primary headlines for the month was yet again Fed related, as a very strong October jobs report. The economy added a strong 271,000 net new jobs, increased odds that the Fed will raise rates in December. While the Fed is unlikely to react to any one economic release, most recent economic data has set the stage for a likely rate hike this month. The market will continue to look to Yellen and the Fed for clues regarding the pace of rate hikes as we move into 2016. While the Fed is poised to begin increasing rates, potentially as soon as December, central banks around the world may take diverging courses. Europe and China appear ready to stimulate their economies with accommodative policy. Throughout November, we heard Mario Draghi, president of the European Central Bank, lay the groundwork for the ECB to increase and extend their bond purchase program into 2016 and beyond. China's weak economic data also makes a compelling case for more stimulus from the People's Bank of China. November also saw the third quarter earnings season come to an end. While a handful of companies still have earnings trickling in, the vast majority of the S&P 500 have reported earnings. The third quarter earnings season has been somewhat disappointing, as earnings are slightly negative year over year. The narrative from earnings calls has been consistent as we continue to see strong headwinds from the energy sector and a strong US dollar. Moving into the fourth quarter of 2015 and into 2016, we believe it is imperative that we begin to see the earnings outlook improve in order to see market growth in 2016. The tragic events last month in Paris were shocking, and our thoughts and prayers are with the victims of these horrific events. While it can be difficult to think of financial markets during times such as these, it's our role to do so. We often get questions from clients about what the right response to a terrorist attack would be in terms of their investments. Often, the question asked is whether they should make big changes in response to attacks. Our answer is simple: probably not. Having a knee-jerk reaction to any market event, especially a terror attack, is often the wrong thing to do, and investors must weigh many factors. Unfortunately, over the last 20 to 25 years, we have a number of terrorist attacks to reference. As can be seen here, the market is often trading at a higher level even just 1 week after an attack. As we look toward 2016, the big question to answer once again is whether we see a recession on the horizon. While the absence of a recession doesn't necessarily mean that we will see strong market returns, it does make a bear market less likely. We believe that the last couple of months most likely show that we're coming out of a bull market correction, but only time will tell. Moving forward, we remain optimistic that this bull market continues to have room to run. However, if you have uncertainty or have felt uncomfortable during the recent volatility, now is a great time to review your overall asset allocation and make sure that your portfolio is built with consideration of these types of periods. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We would also like to remind you to follow us on Twitter and like us on Facebook. Thank you.